concentration is a characteristic of successful business people's behavior. They don't have 50 stocks in their portfolio. They have one. They have their company. They've identified a good business that they can put all their efforts and all their resources into, and they know that if they work hard and run the business in a rational way, they have a reasonably good shot at creating wealth. So this is taking it from success, just how successful business people have been able to achieve that is, they have one business. That's the extreme. That's the extreme case in investing, but it is certainly the most successful. But you better choose right, because if you make a mistake there, then you're finished. You can be finished. And business people who go into one business, the death rate of the mortality rate of new businesses is very, very high. So out of the thousands of companies that are started, most of them die over a short period of time, and that's because they've chosen incorrectly. But when you study successful, real wealth creation of individuals, you see one business at the core of it, whether it's take anybody, whether it's Gillette or Coca-Cola, or we're talking about one business, one product, one business. That's how the wealth was created. It was not created by running 10 different businesses, which in the world of stock market investing would still be regarded as over concentration, and yet you can't run and manage 10 different businesses. It's not reasonable. And then people have the typical mutual fund or the typical investment portfolio has well over 100 businesses in it. I defy anybody to understand 100 businesses. It's not possible. You can't understand and keep track of and know a business to that depth, to a deep level. If you have 100 of them, you can only know a little bit about each of them, and that's how most professional money is managed. It's and the results are what they are. It's not a particularly happy outcome. That's why I think the numbers are like it's at least 80% of mutual funds over the long term underperform indexes. That's why ETFs are so popular. That's why indexes are so popular, because if you have 100 or 200 stocks, you become index-like. You mathematically have to become an index, and then you have trading, trading activity, all this in and out activity, which has frictional costs, and then there's costs of running the money on top of that, and the end result is that you end up with below market returns. It's pretty much guaranteed. So concentration, people view it as a higher risk alternative, and yet that is how, as I say, I'm repeating myself, but that's how wealth is historically been created, whether it's Henry Ford or Larry Ellison. It's been one business, or Apple Computer, or it started with one central idea, one basic one basic thrust, and then there was diversification after that. But the real wealth, the real position in the market was created because they did one thing very, very well.